Hey everyone, Farhan here. So today you will solve question 5 from 2020 past exam. In this question, I'll show you how to prepare the adjusting entries and the closing entries at the end of the reporting period. Here we are working with a business, Andos Imports, which reports annually on 31 December. So you can see that we are given the pre-adjustment trial balance as of 31 December 2019. So what is the purpose of the pre-adjustment trial balance? The pre-adjustment trial balance is prepared to ensure that the total of all debit entries equal the total of all credit entries. This is done to check whether the double entry bookkeeping process is correct so far. If we reveal any errors, then we fix these errors prior to the preparation of financial statements. So we are also given some additional information, and as you can see, in part A, you're required to do the adjusting and the closing entries on 31 December 2019 in the General Journal. So let's start with the first additional information that we have. A physical stock take on 31 December 2019 showed inventory of $82,000. Now, if you check the inventory value that is given within the pre-adjusted trial balance, it's also $82,000 reported within the debit column. And there's really no adjustment to be made in this case because both the stock take and the amount that we have been given within the pre-adjustment trial balance are the same. Now, what about the second additional information? In August 2019, an insurance policy was paid for the year commencing 1 September 2019 at a cost of $3,600 plus GST. So you can see the working on the right-hand side of your screen. So insurance has been paid $3,600 plus GST. So which means the GST that we have paid when we paid this insurance would be 10% multiplied with $3,600, and that is $360. Any GST that we pay goes to the GST clearing account on the debit side. Why does it go on the debit side? Because when we make a GST payment, we can claim this payment against the GST collections that we have from our customers prior to the settlement of GST with the ATO. So basically, whenever you are collecting GST, your obligation with the ATO goes up, and whenever you are paying GST, your obligation with the ATO goes down. Now, GST clearing is a liability account by default, which means when you are collecting GST, you should report it on the credit side of the GST clearing account, which shows that liabilities are increasing with the ATO. But when you are paying GST, you must report that on the debit side to show that you are going to claim this GST with the collections that you have for obligations with the ATO. So that is why within the GST clearing account, you're going to report the GST paid on insurance on the debit side. Now, this insurance that has been prepaid for 12 months, all right? So how do we know it's 12 months? So the question explicitly mentions the insurance policy was paid for the entire year, and that year commences 1 September 2019. So the 12 months that this insurance is valid for starts 1 September 2019 and ends 31 August 2020. So that's how we get this 12 months. Now we are doing the adjusting entries for the reporting period ending 31 December 2019. And given that the insurance is going to be in use from 1 September 2019, from 1st of September 2019 until 31 December 2019, we have 4 months in total that we have consumed the economic benefits that comes with this insurance. So given that we know the annual insurance is $3,600 excluding GST, the monthly insurance that we expect to consume or expense would be $3,600 divided by 12, which is $300. All right. Now, in 4 months, we are consuming $300 per month multiplied by 4 months to find the total, and that would be $1,200 of insurance expense that has been consumed from the insurance, which has been prepaid on the 1st of September, and that was $3,600. This means the prepaid insurance balance that we can expect to have at 31 December 2019 will be $3,600, which is what we originally paid for, minus $1,200 for the economic benefits that we have consumed for the period 1 September 2019 until 31 December 2019, and that is $2,400. So how should we report this prepaid insurance that we have at 31 December 2019? we would report this as a current asset in the balance sheet. Okay. Now, if you check the prepaid insurance within the pre-adjustment trial balance, it's given as $5,800 in total. And you can see that $5,800 has been broken down into $2,200 plus an additional $3,600. The $3,600 refers to the insurance that was prepaid in August and which started 1 September 2019. But prior to that, we have $2,200 worth of prepaid insurance, which would have covered the first 8 months in the financial year 2019, which is starting 1 January 2019 and ending 31 August 2019, right? So from January 2019 to August 2019, we have 8 months in total. So that $2,200, which is what you can see here, would be expensed as well. So the insurance expense for the first 8 months would be $2,200. So altogether, the total insurance expense for the entire year of 2019, given that the business reports on an annual basis, is $1,200 for the month of September, October, November, and December, plus $2,200, which covers January, February, March, April, May, June, July, and August, the 8 months, and altogether we get $3,400. So how should we journalize this as an adjusting entry? We debit the insurance expense, $3,400, which increases the expense that we report in the income statement, and then we credit prepaid insurance expense by $3,400 to reflect that we have consumed the economic benefits that comes with the prepayment of insurance, and as a result, our current assets will also be reduced. And when assets reduce, we credit them, and when assets increase, we debit them. So that is why if you are to journalize this, you debit insurance expense by $3,400 and you credit prepaid insurance expense by $3,400. So here you can see the working space that was given to us, and you can see for the financial year ending 31 December 2019, so I've written 31/12, which is referring to 31st of December, insurance expense debit, prepaid insurance expense credit. All right. So let's move to the next additional information that we have. New equipment costing $6,000 plus GST was purchased on 30 June 2019, and all equipment is depreciated using the straight line method and is expected to have a useful life of 3 years and a residual value of 10%. Okay, so the new equipment was purchased for $6,000, and this is excluding GST. So the GST that we would have paid on this purchase is 10% multiplied by $6,000, which is $600, right? So where should we report this GST payment of $600 within the GST clearing account? We report this on the debit side because this reduces the obligation or the liability that we have with the ATO. All right. So the residual value is given as 10% of the cost in the question. So 10% of $6,000 is $600. Now, what do we understand by the residual value? So the residual value simply refers to the likely selling price at the end of the asset's useful life, or after all the economic benefits have been consumed for the relevant asset, we would be able to sell it for 10% of what it was originally worth. Okay, so let's find the depreciation for this new equipment. Now, if I was to calculate the depreciation, the rate, there's no rate given here, but we know that we are using the straight line method and the useful life is 3 years. So the straight line formula is cost minus residual value divided by useful life. So the cost is $6,000 minus $600 in the residual value divided by useful life of 3 years, which gives us $1,800 per year. But this asset was purchased on 30 June 2019, which means this asset will only be used for the last 6 months in the financial year 2019, which is starting 1 July 2019 and ending 31 December 2019, right? So if the depreciation on an annual basis is $1,800, then on a 6-month basis, it should be divided by 2, which is $900 for 6 months, okay? Now, we also cannot forget the old equipment that we have in the books. Now, if you check the pre-adjustment trial balance, you can see the total of equipment is reported to be $36,000 within the debit column, which refers to the total cost value of all the equipment that we have. Now, given that we have recently purchased an equipment that was worth $6,000, that leaves us with $30,000 in old equipment. All right. Now, this old equipment worth $30,000 was actually in use throughout the entire year. And how do we know that? The question doesn't specifically mention anything regarding the old equipment's usage. So we have to assume that it was in use for the entire year because we do not really have any disposal as well. So, so the old equipment is calculated to be worth at $30,000. And now that we understand that this was used for the entire year in the business, we can find the depreciation on an annual basis. So cost of 30,000 minus residual value of 3,000, which is basically 10% of the original cost of 30,000. And then you divide by 3 years, which gives us $9,000 per year. Okay. So the total depreciation for the new and the old equipment is going to be $9,000 plus $900, and that is $9,900 in total. Okay. So every time you have depreciation and you are to do an adjusting entry or record the depreciation expense, you have to debit the depreciation expense. You have to be specific, the depreciation of equipment, the asset class that we're talking about. So debit depreciation of equipment, 9,900, and credit accumulated depreciation of equipment by 9,900. Now, depreciation of equipment being debited refers to expenses going up. And accumulated depreciation of equipment is basically a contra asset account, which records the reduction that we have for economic benefits consumed for the relevant asset, which in this case is the equipment. So this is an account which calculates all the depreciation or all the economic benefits that we have consumed from this equipment so far. And this is to be always credited. Okay, so let's see what do we have in the next additional information. So additional information number 5, the term deposit was established on 1 March 2019. Interest in the term deposit is 3% per annum payable at maturity. So the term deposit is an asset. Excuse me. The term deposit is an asset. So it's mainly a current asset. And how do I know it's a current asset? So if you see the term deposit value given within the debit column of the pre-adjustment trial balance is $40,000. And it is 12 months, it mentions here, which means this investment has been made for 12 months only. And the reason this is in the debit column is because this is an investment, which is referring to an asset for the business. So given that we understand this is an investment, any interest we have with this investment is going to be an income or revenue for the business. So how do we find that interest? Let's use the annual rate of 3% per annum that's given to us to find the yearly interest income or the interest revenue that we can have. So the interest revenue per annum is 3% multiplied by the investment of $40,000, which is $1,200 in yearly interest, right? Now, the monthly interest revenue would therefore be calculated as $1,200 divided by 12, which is $100. Now, the question clearly mentions that this term deposit was established on 1 March 2019, and we know that this is established for 12 months, and this is going to mature next year, which is end of February 2020. So starting 1 March 2019, and it goes on for 12 months, that means it would end next year, February 2020. So the 10 months that we have this term deposit in use in the current financial year ending 31 December 2019 would be from 1st of March all the way until 31st of December. So the total interest revenue in that 10 months would be $100 on a monthly basis multiplied by 10, and that is $1,000. So this is what we classify as an accrued interest revenue. Why do you think so? Because if you check the question, it says the interest is payable at maturity, which means this is payable at the end of the 12 months this investment is made for, which is next year, end of February 2020. So that means whatever interest income that we have accrued for the financial year of 2019 isn't really something that we have received yet, but we expect to receive this when it matures, end of February 2020. So that is why when we prepare the books and the adjusting entries at 31 December 2019, we have to show this interest income as accrued. Like this is a current asset and we haven't really received this in cash yet. Okay? So how do we journalize this? Right, so we just debit the accrued interest revenue, which is the same thing as interest receivable, referring to a current asset or an economic benefit that you expect to receive very soon. And that's $1,000. And then we credit interest revenue because all revenue is credited by default, similar to how you credit sales and any other revenue, such as discount revenue. So interest revenue is credited by $1,000 to reflect an increase in total revenues or income. And we are debiting accrued interest revenue by $1,000, which is basically showing that assets, mainly the current assets, are going up if you were to record this in the balance sheet, because you haven't received this interest yet in cash. And you expect to receive this end of February 2020 when the term deposit matures. All right, so that's all we have for the additional information. So we are also required to do the closing entries. So how do we do the closing entries? We first close all the revenue accounts. Now, you need to check the pre-adjustment trial balance very carefully. So normally when you're closing all revenue accounts, it's not just sales. It can also be discount revenue or interest revenue. Basically, any revenue that we have, we must be closing that to the profit and loss summary. All right. Okay. So you can see that we are given the credit sales of $350,000. Now, always check for sales returns as well, because if you have sales returns, then it is going to have an effect when you're recording the journal entries. All right. So how do we close these revenues? So when you are closing the revenues, you basically do the opposite of what these revenue accounts are by default. All revenue accounts by default are credit, which means when they increase, we credit them. So now that we have to close them, we have to do the opposite of credit, which is to debit them. So that is why we debit sales by $350,000, which is the value that we have taken from the pre-adjustment trial balance. And be careful to always check for sales returns. In our question, we do not really have sales returns or returns inwards, which is basically customers returning inventory back to us for the sale that we have made them a few days ago, for example. Okay, so if you have sales returns, then that would be recorded differently, which we do not have in this question. So first of all, we are debiting sales by $350,000, then we debit interest revenue by $1,000, which is the other income that we just found out from the last additional information. And the total of both these revenues comes out to be $351,000, which is what we are crediting with the profit and loss summary. Okay. Then we are closing all the expense accounts here. So when you're closing all the expense accounts, you debit the profit and loss summary with the total of all expenses, and you credit all the expenses. Expenses by default are debit, which means when they increase, we debit them. So now that we have to close them against the profit and loss summary, we just do the opposite of debit, which is basically to credit all of them. And each of these values have been either taken from the adjusting entries we prepared or from the numbers that we have from the pre-adjustment trial balance. So let's start with the insurance expense. So this is $3,400, which is what we derived at the beginning. Then we have depreciation of equipment. We calculated the total depreciation for the old and the new equipment. And then we have cost of goods sold and wages. So these two have been taken from the pre-adjustment trial balance, and none of these figures have to be adjusted. So the cost of goods sold is $195,000, and then you've got wages of $78,000, right? So we do not have any other expenses that we need to record. So these are the two expenses that we have included as here as well. So altogether, this four comes out to be $286,300. So you debit profit and loss summary, and you credit each and every expense that you have. Now, I've got a question. So how would you calculate net profit post the closing entries? Like after the closing entries are done, if you were to use these journal entries, how can you calculate net profit? If you guess that correct, you take the total of all revenues that you have closed, which is $351,000, and then you subtract the total of all expenses which you have closed, that is $286,300. So whatever you get here is basically the net profit that we have calculated, and that should be $64,700. Okay, so this is not really a requirement for the question, but just checking that you know what's really happening and you understand the question properly. All right, so what else do we have for part A? Really nothing. So let's go into part B. Explain why some accounts are closed at the end of each reporting period while other accounts are balanced. Right. So we've got this accounting assumption, which is the periodic assumption, and that requires us to calculate profit on a periodic basis. This could depend on the business, if the business reports every 3 months, every 6 months, or every 12 months. But normally the maximum you can expect is 12 months, and you cannot really have more than 12 months. And then we have the accrual basis assumption, which calculates profit based on the revenues that we have earned and the expenses that we have incurred in a given period. So when we subtract the expenses that we have incurred from the revenues that we have earned, we calculate net profit. And that profit must be closed to the capital account, which is what we do using the profit and loss summary, right? Now, revenues and expenses are temporary accounts. They're only valid for the specific period that we are preparing the books for, which in this case is an annual basis. So these temporary accounts, the revenues and expense accounts, they must be closed and reset to zero balances prior to beginning the new financial year, which would be 1 January 2020. And then you have got permanent accounts such as assets, liabilities, equity, which are not closed to profit and loss summary and not reset to zero, but rather those accounts are balanced and carried forward to the next financial year. The logic here is that all the assets, liabilities, and equity that we have are used for a longer term basis, right? But when you have got these temporary accounts, revenues and expenses, these are the core operations of the business. So these revenues and expenses, which helps us to calculate net profit, are the main reasons why the business will survive in the long run and also follow the going concern assumption, right? So this is why you want to determine an accurate profit figure, so that way you can also track whether the business is doing well in a specific time period. So this is why revenues and expenses are temporary accounts which are closed to the profit and loss summary and transferred to the capital account and reset to zero prior to starting the new period. And then you have got permanent accounts such as assets, liabilities, and equity, which are balanced, and we expect to use this for more than 1 year within our business. All right. So that's all for today's lesson. I believe you found a lot of value in this content. Make sure to like this video and subscribe to this channel, and check the link in the description to book a call with me and discuss your tutoring requirements. I'll see you in the next video.